We've now derived the model of economic fluctuations, so-called aggregate demand, inflation adjustment, ADIA, or simply ADIA. And we've also shown how that model can be used. We showed you how to use the model. Now what we'd like to do is to take that model and analyze policy, go over some real-world experience historically and things that are going on now in the economy, and use that model to really figure out what's going on in a very practical sense of the word. I'm going to consider 4 key episodes to show how this model is used in practice. One's going to be called the Volcker disinflation at the end of the 1970s, early 1980s, when inflation came down. We also want to consider some recessions, 1991 recession, that was a pretty serious recession, and 2001 recession, not so deep, and of course a very deep recession, 2007, 2009. I want to see how the model can be used to analyze each of these episodes. So let's start with the Volcker disinflation. In the 1970s, inflation got very high, sometimes called stagflation, because unemployment was also high with that inflation rate and growth was low. You may have remembered a video of Arthur Burns, who was the chairman of the Federal Reserve at that time, testifying on Capitol Hill about the importance of keeping money growth low. Well, he didn't keep money growth low, as you know, and as a result, inflation got very high during the 1970s. It got to the point where even President Ford, President of the United States, thought we could try to reduce inflation by people wearing buttons called win buttons, or whip inflation now. Didn't work, not too surprisingly from an economic perspective. And some even blame this high oil prices, these high inflation rates on oil prices. That is because the Organization of Petroleum Exporting Countries had raised oil prices a lot, and that caused inflation. Finally, by the end of the 1970s, people were sick of this inflation and sick of the high unemployment. And President Carter appointed Paul Volcker to chair the Fed and said basically, in simple terms, get inflation down, Paul, reduce inflation. And so to analyze this, we're going to argue that, in fact, the monetary policy rule shifted towards lower inflation. And that shift of the monetary policy rule can be shown with the policy rule, of course. So here's the diagram which has inflation on the horizontal axis and the interest rate on the vertical axis. It normally says how the Fed has to raise interest rates when inflation picks up in order to control it. But by the end of the 1970s, the inflation rate was quite high, so they had to move their policy response in the direction of lower inflation. And that's illustrated in this picture by the big arrow at the top showing how the curve shifts over to the left, that is, towards lower inflation. Now what happens here, of course, is since inflation doesn't change right away, it takes some time, that initially the interest rate rises. So you can see this in the diagram for a given inflation rate, as shown in the picture. There's an upward movement of the interest rate up towards the point labeled SR for short run. And that increase in the interest rate is what's going to have the first impact on the economy. Over time, inflation will begin to fall, and along this new policy curve, you'll see the interest rate begin to decline again. So we're going to trace out what happens in the overall economy as interest rate rises due to the Fed's effort to get inflation down. And during this period, the interest rate did rise by a tremendous amount as the Fed tried to get inflation down to move to this lower inflation regime. So here's the picture in the ADIA diagram, the aggregate demand inflation adjustment diagram. We're starting, say, at potential GDP in the diagram, and the picture is the intersection at the upper part of the curve here. So we can illustrate this move to higher interest rates by the Fed in order to reduce inflation with the aggregate demand inflation adjustment diagram. So the starting point is where real GDP is equal to potential GDP, and the IA curve intersects the AD curve at this point. Now the Fed tries to reduce inflation, it raises interest rates, and the initial impact is to move the aggregate demand curve over to the left. That's because at those higher interest rates, investment is down, net exports are down, even consumption's down, so it shifts the demand over to the left. And we now have a new intersection of the inflation adjustment line and the aggregate demand curve, And it shows you how real GDP has fallen from where it started out. And that's the initial decline. Now, of course, there's pressure on inflation to go down because real GDP is lower than potential GDP. Demand is lower. Firms see the need to reduce their prices or wages, so inflation falls, and you can see the IA curve comes down. It comes down, and then there's another intersection with the aggregate demand curve. We'll call that at MR for medium run. But it's still greater than potential GDP. Real GDP is still greater than potential GDP, so it's going to continue to decline. The IA curve will continue to decline, and it will do so until you eventually get back to the initial point. And so that's disinflation. The objective here has been achieved. The inflation rate has come down from its initial point where we started to this new long-run point. That was the goal of the Fed. There has been an impact on the economy, however. Real GDP has declined temporarily, but it has declined. And you can summarize the effects with our box or table showing short-run and long-run effects on each of the components of spending. So we know in the short run that higher interest rate has driven consumption down, investment down, net exports down. We're not changing government purchases, so we leave that alone. But as a result of these other changes, real GDP goes down. Long run, everything's back to normal. You basically have the situation where the change in monetary policy has brought the economy back to its potential. The long run effects are zero in terms of the real economy, but inflation is down. So the long run effects of monetary policy have just been on inflation and not on real GDP, and therefore not on unemployment. The impact of the disinflation is temporary. Now that's exactly what happened during the vocal disinflation. Interest rates rose substantially, and as a result the economy slowed down. There was a big recession, actually back-to-back recessions, but eventually the economy returned to potential GDP, and with that lower inflation rate that seemed to be good for economic growth. It had some benefits on the side, so economic growth remained good. It actually picked up by the 90s, and inflation actually remained low, 2–3% for the most part. So that's a disinflation and a description of what actually happened using our ADIA model. Now let's go to the second example, and that is a recession, 1991. So you want to ask, why did it happen? Was it a fiscal policy change, monetary policy, just oil shocks, or something else going on? Well, let's first look at the facts, try to find out what's going on by looking at the numbers, and then look at the way the model interprets those numbers. So here's a picture of what happened. This is a summary of real GDP in the blue line going up over time. It's measured in billions of 2009 dollars. That's real GDP, and on the right is the scale for that. Then you have potential GDP growing along the red line steadily. You can see that fluctuation up and then down. The down is the recession. And then to magnify and focus on that difference between the red and the blue line, we look at this gap, which is just the percentage change, percentage difference between the blue line and the red line, the percentage difference. And that scale is measured over on the left, so you can see the gap growing positively up to about 1.5%, and then going back towards zero and to about minus 1.5%. And that's that fluctuation that we're so interested in trying to explain, represented now by this percentage difference between real GDP and potential. So that's what happened. That's what the numbers are. What else was going on? Well, inflation was moving too. This is a picture of inflation during the same period. We're looking at a few years before the recession and a few years after the recession, and you can see inflation picked up. It was around 2–2.5%. And then it started to rise in 87, 88, up to a little over 4%. And then it started coming down again and eventually returned to where it was. So you had this movement up and down in inflation during this period. And according to the ADIA model, those things are related, the inflation movement and the up and down in real GDP. And the relationship can be symbolized and represented in a diagram where we put one of the variables on the horizontal axis, GDP gap, that percentage difference between real GDP and potential GDP, and on the vertical axis, the inflation rate. And then we plot the points corresponding to each of the observations, each of the quarterly observations between 1987 and 1992. 1987 third quarter is really the first point there, and it's shown in the diagram at the bottom. That's it. And then the next point would be 1987 fourth quarter. first quarter of 88, second quarter of 88, and so on. So you can see the observations, and then we've connected the observations with a line to help you visualize the direction of movement in this diagram. And if you look at it carefully, you can see that in the first few years you're moving in the northeast direction. That's where the movement is. And then you start to move over there, and then you come down here. You can sort of, as you glance at this picture, sort of see a clockwise movement. And you can help see that if you just draw a little line like that. That red line kind of represents that movement. And with the arrows, you can see basically the direction of movement in this picture. And so what we want to do is, can we interpret these really fascinating dynamic movements with our ADIA model? And it turns out we can. So let's see how. There's the model and what the model suggests about what happened. So we want to argue in some detail, as you'll see, that this recession was part of a boom and then a bust. We're going to argue that the inflation rate rose in the late 1980s. We can see that in the data, but perhaps it was because the Fed cut its interest rate. In fact, maybe cut its interest rate too much in response to a very severe crisis in the stock market, the 1987 stock market crash. Probably a good thing to do, but it's also going to have implications for the macroeconomy. In this case, those interest rates being too low will represent a shift in the policy rule. With that shift in the policy rule, we're going to see that real GDP should rise above potential GDP. That's what the model suggests. And then we're going to say, hey, with inflation higher, the Fed probably saw that higher inflation rate and tried to take account of it by shifting monetary policy back again. And so here's the picture that describes that. Those words are nice to say, make sense, but do they hang together in terms of the model? So here's the model again. In the upper part is the aggregate demand curve and just some example inflation adjustment curves to show what's going on. So what we've argued here is that you had a shift in the aggregate demand curve in the short run, and that's because real GDP was above potential GDP, drove up the inflation adjustment curve, as it's shown in the arrow, to this medium run point. And then finally, it continued to adjust up to the long run point. So you can see there was a bit of a boom in which inflation started to rise. You can begin to see that counterclockwise movement. You can also trace those points in the bottom picture, which is a schematic just showing how real GDP went up and then it came down relative to potential GDP. That's just a tracing out the numbers and this boom period that we're looking at. But now you can see the inflation rate has gotten up. We saw that in the data, got up to a little over 4%. And so the Fed will begin to take some action. It shifts the policy rule back in the other direction. There it goes. And this new policy rule generates a shift in aggregate demand to the left. It traces out a short run intersection at the initial inflation adjustment curve where you started this move to the left, and then inflation starts to fall. You move along the aggregate demand curve to the medium run and then finally to the long run. And so you can see now you're back to potential GDP at that original inflation rate. In terms of the actual movements of GDP seen at the bottom, you've got the short run movement, the medium run movement, and long run movement corresponding to that picture at the top. So we've seen the recession. And now if you look at the chart at the top, you see that counterclockwise movement that was in the data. You basically see a movement like this, sort of going around that direction, and that's exactly what we saw in the data when we looked at the connection between these two variables. There it is at that point, that's the movement, and you can see the model is consistent with that. So this idea that the recession was a boom-bust cycle hangs together both in terms of what happened in reality, and it's a way to interpret it with the model. Second question, the 2001 recession. Let's look at that. Was it fiscal, monetary, price shocks, or something else going on? Again, first read through the facts, see what was going on in the economy. Here's a picture, the same kind of picture that we've used before. We have real GDP and potential GDP in the upper part of the diagram, and the scales are measured over on the right. We have the percentage deviations of real GDP from potential GDP, illustrated by the green line, and its scale is over on the left. The time period is a few years before the recession in 2001 and a few years after the recession in 2001. So it's now pretty clear what's actually happened in the numbers. This is the data. This is what actually happened in the economy. So how can we think about this, what's going on? Well, let's look at inflation again. Whoop, looks the same kind of pattern as before. We see inflation picking up, reaching a certain value, and then going back down again. Now, this move in inflation is smaller than the one we saw in the earlier recession, but it's the same general kind of pattern. It might suggest that this recession is not as severe as the other one, and indeed it is not. But that's the movement of inflation. Now let's connect them together with the diagram with the real GDP, really the gap in real GDP on the horizontal axis and inflation rate on the vertical axis. Same kind of concept. We're plotting the points now from the first quarter of 1988 to the second quarter of 2002, and the recession is in the midst of that. Plot the points and then connect the dots. Connecting the dots gives you a sense of direction. And so you can see now as you move from 1988, 1998 to 1999 to 2000, you're moving in the northeast direction. Inflation's going up and real GDP is going up. And then you move towards the left and then finally down. There's that counterclockwise movement again. It looks like it's somewhat recurrent, and you should kind of put these arrows in to just make sure that that's the direction of movement. And so that's what happened. Again, what's the explanation for this? Well, it actually looks pretty similar to the recession before this. And in fact, the story probably hangs together quite well. Here's the story. You had another boom-bust cycle, this one smaller in scale. But in this case, the inflation rate rose. Didn't rise that much, but it rose in the late 90s. It probably was because, according to the model, that the Fed cut interest rates too much, shift in the monetary policy rule. Why did this happen? Well, there was a financial crisis in 1998 around the world. A financial firm in the US, a famous financial firm, long-term capital management, failed and was rescued by other banks, other financial institutions at the urging of the Federal Reserve. Federal Reserve actually did cut interest rates in response to this crisis, and so it moved away from its typical policy rule. May have been a good thing to do, but it's going to have these macro impacts. In fact, real GDP will rise above potential as the policy rule changes. If the Fed wants to still combat inflation, it will try to combat that inflation, try to reduce inflation. That will cause GDP to fall. You'll see a recession, a smaller one this time, a smaller recession because the movement of inflation is smaller. And again, does the ADIA model fits this? Let's take a look. Well, there's the model. In fact, by now, it should be clear, since the direction of movement was almost the same, since we had the same plausibility of an impact of the Fed, why don't we just go through and put all the points right there really quickly, because the story is the same. The same kind of story should explain this. Initial movement of the policy rule lowers interest rates, shifts the aggregate demand curve to the right, stimulates investment and consumption. But that inflation starts to pick up, and so it starts to diminish the impacts as the interest rate rises due to the Fed, and then they realize inflation's too high, and so they move back in the other direction, and the economy moves in the negative direction. There's a recession, but then it begins to recover as the inflation rate comes back to where it was, and the up and down is shown in the bottom picture with real GDP. It's really the same kind of story. So it works. It works, and now we can see these three cases, the disinflation of Volcker and 2 recessions since then.